Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton and thank you for joining me. The Australian dollar is near the monthly lows and supported by the level of 64.80 following the RBA's rate announcement, which widely, as expected, kept rates on hold at 4.35% for the fourth consecutive time. The statement indicated the shift from the February meeting, with the RBA not ruling out any options. This change was interpreted by the market as a signal that the RBA has removed its hiking bias. Despite signs of moderating inflation, the RBA remains cautious about the domestic and abroad uncertainty economic outlooks. Looking ahead now, markets now position themselves for the Federal Reserve's policy meeting conclusion on Wednesday, New York time, and therefore seeking clues on the next interest rate cut. Many now predict the Federal Bank is now looking at June as a possible cut. Also, Thursday, the Australian Labor Department will release its data, with forecasts predicting a 40,000 increase in new jobs for February, and the unemployment rate is expected to decrease from 4.1 to 4%. Meanwhile, the US dollar, which measures the greenback strength against a basket of six major currencies, holds around 103.90, and I still anticipate a weaker play into the coming days and therefore look towards 103.30 and maybe even lower. As the support level holds at 64.80, I anticipate the market may bounce from there and look back towards that key level and a 60-day moving average around 66 cents. A break there will give further scope on towards 67 cents. Moving on to the euro, we can see the market is a little bit mixed after posting a weak hammer on Tuesday. Nevertheless, we can see the support level holding around 108.05 to 45. If we do see a further increase, a break beyond 109.05 should ignite the move to 109.60-65 and reassess, with 110 figure 15 seen above. Market surged on Tuesday as the Bank of Japan raised rates for the first time in 17 years, shifting from a negative 0.1% to a positive 0.1%, and ceased its NIRP and YCC mechanism. However, the market did perceive the move as somewhat dovish, which led to the yen surging in terms of weakness and now back towards levels seen in November. From there, the market is now speculating that the Bank of Japan may intervene if the yen weakens further, and therefore traders should proceed cautiously and reevaluate their positions and adjust strategies in line with sound risk management principles, given the fact is that we could see a rejection and fall back towards the bottom side of the range, seen somewhere around 149. As Super Thursday quickly approaches, there was a bit of a whipsaw price action for sterling as the market found support close to bottom side around 126.65. From the knee-jerk reaction, the market is in a better position to maybe recover and move on towards 128 as a potential target and reassess from there. Gold a little bit whipsaw, but again finds support around 2,144 to 46. And in light of that, while that is intact, the upside target may still hold towards 2,184 to 88 and reassess from there. Locked in a tight range, it will be a little bit whipsawed into the FOMC rate decision, so do be on your guard when it comes to trading this market. Moving on to oil, the market reached its objective of $83, given by the inverse head and shoulders, and therefore leaves me in a neutral stance. As the market is overbought, the trend is overheating, so we could get a correction or profit taking coming back into play as we have moved quite a considerable way. So as I mentioned, the view is neutral and reassess from current levels. Well, that's a wrap. Thank you for joining me, and as always, look at the intraday report and I hope you enjoyed the great start to the day.